In November 1910, a United States senator sent private instructions to 6 of the most powerful financial figures in America. Come one at a time, tell no one where you were going, use only your first name. The men arrived separately at a train station in New Jersey after dark. They carried hunting rifles. They boarded a private car. The blinds were drawn. One of them had borrowed a shotgun specifically to make the disguise more convincing. They were not going hunting. They were going to Jekyll Island, a private resort off the coast of Georgia so exclusive that Munsey's magazine had described it as the richest, most exclusive, and most inaccessible club in the world. Between them, those 6 men represented institutions controlling approximately 1/4 of the entire world's wealth. One was a United States senator. One was the Assistant Secretary of the Treasury. The others were the most senior partners at J.P. Morgan, Rockefeller's National City Bank, and the most powerful European banking families operating in America. And for the next 9 days, they designed something, in secret, that nobody was supposed to know about. For 20 years, every single one of them denied the meeting had ever taken place. The founder of Forbes magazine somehow discovered the truth in 1917 and published it. Nobody believed him. What those 6 men designed on Jekyll Island in November 1910 became the Federal Reserve. And the question nobody asks is not what they built. It is why they had to hide while building it. Stay with me, because the answer to that question, why 6 of the most powerful men in America had to disguise themselves as duck hunters to design your central bank, tells you everything about how the system you live inside was built, and who it was built for. To understand why those 6 men were on that train, you need to understand what America looked like in 1907. Between 1863 and 1910, America had experienced 3 major national banking panics and 8 more localized ones. No central bank existed, no lender of last resort, no mechanism to stop a banking panic from becoming a full economic collapse. In October 1907, the system broke. A failed attempt to corner the copper market triggered a collapse of 2 major New York trust companies. Depositors panicked. They lined up overnight outside healthy banks to withdraw their savings. The contagion spread from New York to every major city simultaneously. The United States government had no tool to stop it. One man did. John Pierpont Morgan, 70 years old, operating from his private library on Madison Avenue, personally coordinated the rescue of the American financial system. He called the most powerful bankers in New York to his library. He locked the door. He told them how much each institution would contribute to the rescue fund, and he kept them in that library until they agreed. The Panic of 1907 ended because one private citizen had enough personal authority to stop it. That single fact terrified Washington more than the panic itself. A democratic republic whose financial stability depended on the personal authority of one unelected private banker was not a stable system. Senator Nelson Aldrich, chairman of the Senate Finance Committee and the most powerful financial legislator in Washington, spent the next 2 years studying European central banking systems. He visited England. He visited France. He visited Germany. He came back convinced. America needed a central bank, but he also came back with a problem. The word central bank was political poison in America. Andrew Jackson had destroyed the Second Bank of the United States in 1832, calling it a monster serving the wealthy at the expense of ordinary Americans. That memory had not faded. Any proposal carrying the word central bank would die in Congress before it was read. Aldrich needed a plan that was a central bank in everything but name. He needed people smart enough to design it, and he needed to keep their identity secret, because if Americans discovered that the plan had been written by the senior partners of J.P. Morgan and Rockefeller's bank, it would confirm every suspicion they already held. In November 1910, he made his calls. Now here's what happened on Jekyll Island. Because the 9 days those 6 men spent on that island produced something more consequential than almost any legislation in American history, and the way they designed it reveals exactly why it had to be designed in secret. Jekyll Island in November 1910 was empty. The wealthy families who summered there had returned to New York. The staff maintained the facilities. The island was quiet, isolated, and accessible only by private boat. Perfect. The 6 men worked from dawn until late into the evening for 9 consecutive days. The central disagreement emerged immediately. Aldrich wanted a straightforward central bank, modeled on the Bank of England. A single institution with a single board controlling monetary policy. Paul Warburg, the most technically sophisticated banker in the group, trained in the European banking tradition, disagreed. Not on substance, on strategy. Warburg understood American political psychology better than Aldrich. He knew that a single central bank controlled by Wall Street would never survive congressional scrutiny. His solution was architectural. Don't call it a central bank. Call it a reserve system, Don't give it one location. Give it 12 regional banks scattered across the country in Dallas, Richmond, Chicago, San Francisco, so it appears decentralized and democratic. Don't let Wall Street bankers appear to control it. Put a Washington-appointed board at the top so it appears to be under government oversight, but design the actual power to sit with the regional banks, which would be owned and governed by the private member banks they served. The appearance of public control, the reality of private architecture. Warburg's Vision 1. The document that emerged from Jekyll Island after 9 days was called the Aldrich Plan. It proposed a National Reserve Association, not a central bank, with 15 regional branches, not one headquarters. Frank Vanderlip later wrote in his memoirs, "I do not feel it is any exaggeration to speak of our secret expedition to Jekyll Island as the occasion of the actual conception of what eventually became the Federal Reserve System." The Aldrich Plan was submitted to Congress in 1911. It was rejected. Not because the idea was wrong, but because Aldrich's name was on it. He was too visibly connected to Rockefeller interests. His bill carried the smell of Wall Street before a single senator had read it, so they renamed it, dropped Aldrich's name entirely, reframed it as a Democratic bill under Virginia's Representative Carter Glass, changed the political packaging, left the substance almost entirely intact. On December 23, 1913, 13 days before Christmas, when most Americans were not paying attention, President Woodrow Wilson signed the Federal Reserve Act into law. The system Paul Warburg had designed on Jekyll Island became the law of the United States. Now here's what that system has done in the 113 years since Wilson signed it. Because this is where the Jekyll Island story stops being history and becomes the explanation for every financial crisis, every inflation surge, and every wealth transfer you have lived through. The Federal Reserve opened for business in November 1914. Its stated purposes were clear: prevent banking panics, provide a lender of last resort, stabilize the American financial system. Within 2 decades, it had helped produce the worst economic collapse in American history. The Federal Reserve's policies between 1929 and 1933 are now widely accepted by economists across the political spectrum as having significantly worsened the Great Depression. Rather than expanding the money supply to offset the banking collapse, the Fed contracted it. Over 9,000 American banks failed, unemployment reached 25%. The institution designed to prevent exactly this outcome made it worse. But the more consequential story is not the crises the Fed failed to prevent. It is what the Fed's existence made permanently possible. Before 1913, the United States government could only spend what it collected in taxes or borrowed at market rates. After 1913, a new relationship existed between the Treasury and the Federal Reserve that made deficit spending structurally easier. The dollar that existed when the Federal Reserve opened in 1914 and the dollar that exists today share a name. They share almost nothing else. If you held $10,000 in 1913, the year the Federal Reserve was created, and left it in cash, today that same $10,000 effectively buys what $310,000 used to, a 97% reduction in purchasing power, in 113 years. Under the stewardship of the institution, those 6 men designed in secret specifically to protect the value and stability of American money. The 6 men on that train knew Americans would never accept a central bank if they understood who was designing it and why. They were right, which is why they borrowed shotguns. Before we go further, I want your honest answer in the comments. The Federal Reserve was designed in secret by representatives of J.P. Morgan, Rockefeller's bank, and European banking families, then presented to Congress as a democratic reform. Was that the necessary architecture of a system that has prevented dozens of potential crises, or the most consequential deception in American financial history? Drop your answer below, because what the Federal Reserve is doing right now makes that question more urgent than it has ever been. In 2026, the Federal Reserve is the most powerful central bank on earth. Its decisions on interest rates affect every mortgage payment in America, every business loan, every government borrowing cost. But its influence extends far beyond American borders. Because the dollar is the world's reserve currency, every central bank on earth holds dollar reserves. Every commodity is priced in dollars. Every international debt is denominated in dollars. When the Federal Reserve raises interest rates, borrowing costs rise for governments in Brazil, Turkey, South Africa, and across the developing world simultaneously. Nations that had no representative in Warburg's Jekyll Island meetings and no voice in the system he designed absorb the consequences of its decisions every time the Federal Open Market Committee votes. This is the exorbitant privilege de Gaulle warned about in 1965, the same privilege Nixon exploited in 1971 when he closed the gold window. built on the architecture those 6 men designed on Jekyll Island. And now, the Federal Reserve is coordinating with the Bank for International Settlements on the next evolution of that architecture. Central bank digital currencies, programmable money, Project Nexus. The system designed in secret in 1910, being upgraded in 2026. With the same level of public consultation those 6 men offered in November 1910, which is to say, none. And here is the question that the Jekyll Island story forces, not about conspiracy, not about malevolence, but about something more fundamental. About what it means when the architecture of your financial life is designed by people who understood that if you knew who was designing it, you would never accept it. Frank Vanderlip wrote in his memoirs decades later, "There was an occasion near the close of 1910 when I was as secretive, indeed as furtive, as any conspirator. I do not feel it is any exaggeration to speak of our secret expedition to Jekyll Island as the occasion of the actual conception of what eventually became the Federal Reserve System." He used the word conspirator himself, not as an accusation, as a description. The men on that train understood exactly what they were doing. They understood that the connection between their identities and their proposal would destroy the proposal. They understood that Americans, if given full information, would reject the system, so they designed the system first, and let Americans discover what it was after it was already law. This is not unique to 1910. Nixon closed the gold window in 1971 without asking you. The BIS designed the Basel Accords without asking you. The same institutions are now designing programmable money without asking you. The pattern that began on Jekyll Island, design first, inform later, never ask, is not a historical curiosity. It is the operating logic of the financial architecture you live inside. Understanding that the Federal Reserve was designed in secret by men who knew it had to be secret does not mean the institution is purely malevolent. It means the institution was built with a specific set of interests embedded in its architecture from its first day of operation. And those interests have shaped every interest rate decision, every quantitative easing program, and every monetary policy choice made in that building for 113 years. The 6 men on that train in November 1910 are gone. Their design is not. It processes every dollar you earn, every dollar you save, every dollar you borrow. And it was never, not once, submitted to a public vote. Was the Federal Reserve the necessary architecture of modern financial stability, or the most consequential system ever designed to serve private interests while appearing to serve the public? Drop your answer below. If this connected what most American history never connects, subscribe. The next episode goes deeper into what the 6 men on that train built into the Federal Reserve's architecture, and why it has never been fundamentally changed.